Dear client, the current global market is more unpredictable than any time in the past 10 years. However, in the near term, the macroeconomic environment is still beneficial for risky assets. To summarize, there are 4 drivers to boost the near-term or even mid-term stock markets, as well as the commodity markets. First is the US-China trade war truce. There is a very good news for the global supply chains, which have already been shattered ruthlessly by the trade war. The truce is especially beneficial for the multinational companies in the global supply chains, which generate a substantial portion revenue from doing business with China. Second one is lower interest rates. US is expected to cut interest rates, predicted 1 to 3 times, up to 0.75% this year. This is beneficial for listed companies. Lower debt burden, more aggressive to expand business, with a few caveats. Cheaper US dollar is expected to depreciate due to deteriorating fiscal deficit, the gap between government revenues and expenditures, as well as the expected lower interest rates. Historically, a cheaper US dollar is not only good for the US economy, but also beneficial for the emerging markets. The fourth one is higher inflation. Lower interest rates leads to higher inflation. Higher inflation plus cheaper dollars equals bullish stocks markets, bullish commodities markets. Let's first explain the first reason, US-China trade war truce. On 29th June, Mr. Donald Trump agreed to a truce with China's President Xi Jinping to temporarily suspend his threatened imposition of duties of up to 25% on to $325 billion worth of Chinese imports. The S&P 500 reacted positively to the news the next trading day on 1st of July, up 0.77%. A full-blown US-China trade war is detrimental not only to the American and Chinese economies, but also the global economy as a whole. The OECD predicts that a trade war between America and China could take 0.7% or about $600 billion of global growth by 2021. Specifically, a full-blown US-China trade war is especially detrimental to the US-listed multinational companies with a substantial portion of revenue generated from doing business with China. In S&P 500, 40 companies are with more than 10% of explicit asset exposure to Greater China. More of them are technology conglomerates such as Apple at 20%, Intel at 40%, Qualcomm at 65%, etc. As of financial year 2017, a decelerated trade tension would definitely revive those companies' overall business and the securities market performance. Second reason is lower interest rates. On 10th of July 2019, despite just released strong job data, Jerome Powell, the chairman of the Federal Reserve, hinted that the central bank is looking to cut interest rates in the same month. America's stock markets soared after Mr. Powell cited concerns that the trade war with China and global slowdown could hurt growth in America. Based on the present value of future cash flows, falling interest rates make all streams of future income more valuable. That includes dividends from stocks, coupon on bonds, and homeowners' privilege of being able to occupy the houses without paying hefty rent. Lower interest rates also bring lower capital cost to listed companies. Companies are able to pay less interest, borrow more to expand, and hence boost the value of their assets, like shares, bonds, etc. In the long run, if growth and inflation together exceed the interest rates, existing debts will shrink relative to GDP over time, which is what governments wish to see. There are, however, a few caveats as well. Hefty asset prices and tremendous amount of borrowing rest on the assumptions of permanently low and stable interest rates, making it more fragile than it looks. If rates rise, there will be distress among some firms and trouble in debt markets, like the sell-off in late 2018. If, by contrast, the Fed has to cut rates to near zero for a prolonged period of time to sustain growth, it could weaken the banks, as Europe has found. The next reason would be cheaper USD. There are 2 main reasons why USD depreciation in the midterm, why there is a USD depreciation in the midterm future. One is US fiscal deficit, the gap between government revenues and the expenditures, and one is lower interest rates. The US President Donald Trump has cut taxes enough to push the deficit above 4% of GDP despite a healthy economy. According to Macquarie research, historically, there is a high correlation between US dollar exchange rate and US budget balance. The higher the deficit, the cheaper the US dollar. So this is the picture. There are two key factors for a cheaper US dollar to boost emerging markets. The first is a reverse of cash flows. A cheaper US dollar makes investment in US assets not so attractive as that when the US dollar is appreciating, leading to capital inflows to emerging markets. The second factor is less visible. Many emerging countries hold a lot of US dollar denominated debt. When the USD is cheaper, so is the US dollar denominated debt. Hence, in a cheaper US dollar environment, emerging market governments, corporations, and banks always take advantage of a low-cost dollar finance to shore up their finances and boost the economies. The last one could be higher inflation. Lower interest rates normally lead to higher inflation, and higher inflation normally leads to higher commodities prices. Besides, since the prices of commodities are denominated in US dollar, a cheaper US dollar also means higher commodities prices. Historical data also shows the positive correlation between inflation and commodities prices. Okay, this one is the historical data picture. So currently, commodity prices are at most undervalued level in the past 20 years due to prolonged low level of inflation since last financial crisis in 2008 to 2009. If history can repeat, we may see another 10 years of bull markets for commodities. So to conclude, to summarize, the current macroeconomic environment is still beneficial for risky assets. As long as there is no correlation, there is no acceleration for the trade war between US and China, lower US federal interest rates will boost the global economy, while US dollar depreciation favors the emerging markets more than it favors the US market. Besides, a cheaper US dollar together with higher inflation will boost the commodity prices, the commodity markets as well.